Fast one here on the Schwab Network. It's time for cash tags. For that, let's bring in our next guest. It's going to be Andy Swan, co-founder at LikeFolio. Welcome back to the show, Andy.
Thank you.
All right, so we're talking food. It's almost lunchtime. Yum Brands up only 3% from year-ago levels. This has been a choppy trade, Andy. You know, it seems like maybe one or two of their franchises does well. The other one drags on their earnings results. But what kind of data are you seeing on Yum Brands going into earnings?
Yeah, I think it's the same old story. You just summed it up really nicely. We think Taco Bell is performing very well. You know, if we look at monthly active users on the Taco Bell app, that's up 30% year over year, which tells us that brand is doing very well. But then when you compare it to all the other brands in the kind of fast food segment, all of Yum Brands web visits are down year over year. Only Chick-fil-A really and Burger King are doing well at this point. I think Burger King was off of pretty low lows, so we kind of throw that one out. Overall, we're seeing the fast food industry just kind of getting a reset. You know, in 2023, we saw a real peak in both spending and overall, you know, food consumption of fast food. I think that the customer is definitely cutting back, and the fast food industry is facing a real value proposition problem because of the the rise in expenses of workers, of food costs, and everything that they're trying to pass through to consumers. And all of a sudden, you know, your fast food meal is becoming, from a price perspective, similar to, you know, going to a sit-down restaurant or at least a fast casual restaurant. So we see the fast food industry is struggling right now. It's kind of holding ground. There's really not a lot of growth there except for in Chick-fil-A and a little bit in Taco Bell. So as we go into this earnings report, we think Yum is kind of where it's been for the last year, and why the stock hasn't moved that much is because not that much is happening. They're really in a position of defending what they have via their best brand, Taco Bell, and using that to cover for some of the weakness in KFC and Pizza Hut. This is a story we've seen for a pretty long time with Yum Brands. We expect it to continue for some time.
Andy, I'll give you a microcosm of what's hurting fast foods right now. I had my 28-year-old son last night lecturing my 25-year-old son on you got to stop eating out. Food costs too much. You got to make your food at home. I sat there in amazement as I saw the evolution of the young adult, because when you're looking at a fast food bill that used to be, $5 or $6 or $7, now it's 12 or 13. People are starting to hit the wall, especially if it's not high quality food. Now, Chipotle, Chick-fil-A, some of those more high quality restaurants are still hanging in there, but some of these places like Taco Bell, and you're right, Tom, Taco Bell, KFC do well. Pizza Hut is a drag on their earnings. A little trivia, Yum Brands used to be owned by PepsiCo back in the day. They spun it off into Yum Brands, but this is a company, they still do the franchise model, so they are in somewhat ways insulated from some of the big swings, but this is still a company that's got to get it right. They're in chicken, they're in Mexican, and they're in pizza. You should think that'd be okay, but I think you're hitting an inflection point with some of these young adults in fast food.
Yeah, well, the inflection point is, it's twofold. I think there's a move towards healthier eating that has definitely taken hold, especially among younger people, which is fantastic to see. I actually think that these fast food companies, the best fast food companies like Yum Brands, McDonald's, etc., they're going to be okay with that. I think they can pivot their offerings really well and execute on that really well. So I think rolling out healthier options won't be a huge problem for them. But it is really, the other part of the problem that they're facing, again, especially with young people and actually all adults. You go to a Chick-fil-A or you go to KFC, and in the back of your mind, you're expecting for your family of four to be 40, maybe $50 on the way out, and instead you're getting charged $85, $95 for this trip. It just makes it really difficult to justify that drive-through the next time, and it's just wearing on people. And so, we're starting to see this value proposition. I think that's by far their biggest problem. The healthy eating activity, I think they can manage that. They've proven that in the past, but from a value perspective, it's just really tough for these companies to maintain profit margins and deliver a value to their customers, and they're just getting squeezed, and I don't see that ending anytime soon.
Andy, that kind of leads me into my question. If you look at it's not a true competitor, but the ticker symbol EAT, Brinker, where that stock's up 325% over the last year, and you talked about value proposition and inflation. Here's a sit-down restaurant where you can get a burger and some other stuff for like $10. So they're like competing now with Taco Bell, with KFC, and maybe the food quality is better. Is that maybe one of the things that people should be looking at when they look at maybe a Yum Brands or a McDonald's or even a Chipotle, which was down at post earnings also, where hey, the field is getting more level here, and if you want a better product, you're willing to pay maybe the same or a little bit more for that product.
Yeah, absolutely. I think the stock charts tell the story. The other thing that tells the story is, for the first time, I can remember in my lifetime for sure, is, these sit-down restaurants are actively advertising against fast food competitors because their prices have come so close to in line that now a Chili's or an Olive Garden can go out there and say, why are you driving through for a sloppy burger and fries when we can give you, unlimited pasta tonight for your whole family? And they, you show everybody sitting down enjoying a good time. And it's a compelling message that makes you double think, some of your old habits. And I think that's part of the problem that Yum Brands is going to have to reckon with is, we've either got to get our menu prices down somehow, or we have to improve the experience, which historically we are not very good at doing. And so they're in a tough spot. We'll see what the earnings call says. I think that the outlook will be the biggest part of this, and I think it's going to be murky.
What's your score on this one, Andy? Because you mentioned even Olive Garden. So Darden Restaurants, that just hit an all-time high yesterday. What's your earnings score for Yum Brands going into this report?
Unfortunately, we could not be more neutral on Yum Brands, and I think the stock price is where it was, basically a year ago. I think it's going to stay in this range. It's a great company in a really tough spot, one of the best executing companies, but facing a lot of headwinds, so I think it's stuck for a little while.
All right, neutral there out of LikeFolio. Great stuff as always, Andy. Appreciate it.
Thank you.
All right, that's Andy Swan, co-founder of LikeFolio, breaking that down. Kevin, I think